VICI Properties, ticker symbol VICI, is a real estate investment trust. They specialize in casino and entertainment properties. They have some of the most well-known properties in the world. These include Caesar's Palace, the Venetian, MGM Grand Las Vegas, and Harrah's Las Vegas. It was formed in 2017 as a spin-off from Caesars Entertainment Corporation. They currently have a $30 billion market cap and a 5.5% dividend yield. In this video, we're going to be looking over VICI's financials, looking at the risks, and looking at the possible growth opportunities. Taking a look at VICI's investor presentation, you can see 100% of their leases are triple net leases. What this means is that the tenant, or the lessee, promises to pay all the expenses of the property, including the real estate taxes, building insurance, and maintenance. The most impressive thing about VICI as a company is their rent collection. They have so far collected 100% of the rent owed to them, which is incredible. As you see here, most other triple net leases collect between 70 and 99%. I have yet to see another company that has collected 100% of the rents so far as they've been public. Taking a look at VICI's dividend durability and growth, they have an annualized 7.6% compound annual growth rate while targeting a 75% AFFO payout ratio. If you take a look at VICI's one-year chart, you can see that they're down at 13.7%. The reason why they're down is because of interest rates. Interest rates have really hit hard on the real estate market, and it really has taken down almost all their competitors too. Looking at VICI compared to some other REITs this year, you can see that they're almost all down, including this SCHH, which is a REIT ETF. They've all had a rough year because of interest rates. But I actually see this as a good thing, because while it hurts their short-term growth, it allows investors to get in at a better price. As you can see here, their price to FFO, which is funds from operation, is 12.5. That's a way that most investors are able to tell whether REITs are more expensive or not. It's kind of like a PE ratio for REITs. Taking a look at VICI's revenue, they've had incredible growth. Since in 2018 having $900 million in revenue, to in this year having $2.6 billion. Breaking it down by quarter, you can see they've continuously grown their revenue. They have a 3-year CAGR of 47% and a 5-year of 31%. So the only data we really have is from the past 5 years, as they are a newer company. But for these 5 years of data that we have, it looks incredible. Looking at their net income also looks great. You can see it's also on the rise, and it has a 50% 3-year CAGR and a 35% 5-year CAGR. Taking a quick look at the balance sheet, you see they have $42.8 billion in assets and about $511 million in cash and short-term investments. They also have $18.7 billion in liabilities, which is mostly made up of long-term debt, which is $17.5 billion, but this shouldn't be a problem because of how good their free cash flow is. Speaking of free cash flow, looking at their cash from operations, you can see they had $500 million from cash from operations in 2018, and it grew to $1.9 billion in 2022. It is a 42% CAGR in the past 3 years and a 31% 5-year CAGR. And every dividend investor's favorite part is the dividend. They've had 5 years of consecutive dividend payments, which is how long they've been a public company, and 5 years of dividend growth, which means every year they've been a public company, they have grown the dividend. Looking at the dividend history, you can see that their first dividend they paid 16 cents in 2018, and in 2023 they paid 42 cents per share. So they've been growing their dividend quite nicely. Looking at the dividend safety, you normally look at the dividend payout ratio, but with REITs you look at the AFFO payout ratio. The AFFO payout ratio for the past 12 months has been 75.94%, and the forward-looking is 74%. This is right in line with their 75% AFFO payout ratio. In Simply Safe Dividends, it says VICI may be undervalued. The reasoning is because their dividend yield is 11% above its 5-year average. As you can see here, its 5-year average is 5.03 and it is currently 5.57. And it has a lower than usual forward price to AFFO ratio. Their normal AFFO ratio in the past 5 years has been 14.8 and it's currently 13.4. So it's trading lower than what it normally does. Once again, this is because of interest rates. The first risk of VICI is the interest rates. Interest rates have obviously hurt the real estate market pretty badly over the past 2 years, but it's expected to start decreasing. So the market has already priced in that it's probably going to be decreasing. If it doesn't decrease as fast as the market wants, it'll probably hurt real estate in the short term. But once again, I don't think this could be a long-term problem for VICI. The second concern with VICI is how concentrated they are. 83% of the rent comes from the top 3 tenants, which are Caesars, MGM, and the Venetian, and it's very heavily located in Las Vegas. This can be seen as a positive or a negative. If you think Las Vegas tourism is going to be going down over the next couple of years, it's a risk. And if you think it's going to do well, it should do pretty well. Las Vegas tourism has been increasing since in 2022, 38 million people visited, which is a 20% increase from 2021. So the question is if Las Vegas tourism is going to continue increasing. On the other side are the deals that VICI does. As you can see, on October 19th, they made an acquisition of 38 bowling entertainment centers from Bolero, which is another publicly traded company. And in 2023, they announced a partnership with Homefield Kansas City in youth sports recreation campus and a Margaritaville resort. So, as you can see, VICI's been diversifying their portfolio and it's been doing pretty well. What do you think of VICI? Do you think VICI is going to do well over the next 5 years? Leave a comment and let me know.